This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 432 was produced on June 13th, 2024. I'm Eric Townsend. Goldman Sachs' former global commodity strategy chief, Jeff Currie, surprised everyone when he left Goldman to join PE firm Carlyle, where he's heading up a new group focused on energy transition and a new approach to investing in energy transition, which corrects some of the mistakes of the ESG movement. Jeff joins me as this week's feature interview guest. I'll ask him about the new fund he's launching right after we talk commodities, from precious metals to energy to softs, including cocoa and coffee, and why they've seen so much volatility recently. Then be sure to stick around for our postgame segment, when I'm going to hit Patrick up with some questions about portfolio hedging and a new series of free webinars Patrick's working on after our usual chart deck and postgame market wrap.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, June 12, 2024. The S&P 500 September futures were up 116 basis points, trading at 54.92. The S&P 500 closed at an all-time new high, and we'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The US dollar index up 36 basis points, trading at 104.68. The July WTI crude oil contract up 598 basis points to 78.50. Material mean reverting rally off its deeply oversold condition. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The July RBOB gasoline up 170 basis points, trading to 239. The August gold contract down 88 basis points to 23.54, continues to trade in a range. Copper down 87 basis points to 456, and uranium down 266 basis points to 86 even. Breakdown in prices were as low as 82.90 on an intra-week basis. The 10-year U.S. Treasury yield up 1 basis point, trading at 4.31. The key news to watch this Friday is the University of Michigan Consumer Sentiment, and next week we have the Empire State Manufacturing Index, retail sales, the Bank of England policy statement, and the European and U.S. flash manufacturing and services PMIs. This week's feature interview guest is Goldman Sachs' former global commodity strategy chief, Jeff Currie, with an in-depth conversation about where we are in the commodity markets today. Eric's interview with Jeff is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Jeff Currie. Many of you know him from his former role at Goldman Sachs. Jeff has recently moved to Carlyle, where he's the chief strategist of energy pathways. Jeff, it's great to get you on the show. It's been way too long since we talked. I want to start with what the heck happened last Friday. Through Thursday night, gold market was looking terrific. It had seemingly rejected the 50-day moving average, was rallying very nicely above that. Everything looked great. All of a sudden, as Europe opened on Friday morning, the selling began and just wouldn't quit, with gold down $100 in a single day. As far as I could see, there was some U.S. economic data that didn't come out until 8:30. The selling started 4 hours before that, so I don't think it was economic data. Any idea what happened here? Was there some major change that happened at Friday's open in Europe?
Well, it was economic data from the Chinese central bank showing that they had quit buying gold for the previous month. And it also showed some tapering of their gold purchases as prices started to rise at the beginning of this year. Obviously, I take the view that 1 month doesn't establish a trend, and commodities more broadly, whether it's copper or oil, that is the pattern of the Chinese. When prices come down, they buy a lot more. As prices go up, they taper their demand back. So I guess if you cover all commodities, oil and copper, the behavior you're seeing from the central bank with gold shouldn't be that as concerning. It doesn't establish a trend. But for those of you who do not understand the importance of demand coming from the Chinese central bank, maybe it's worth taking a step back and talking about why gold and I'll throw Bitcoin into that are the two best performing assets across the financial world this year in 2024.
Jeff, let's go a little deeper on that central bank demand. First of all, big picture, it seems like this massive gold rally we've seen over the last 6 months has been driven primarily by central bank demand. So why are central banks suddenly such big buyers of gold when it seems like retail interest has waned almost completely? And where is this headed from here? And particularly, what is with just one data report that is, I understood that report because I saw it at the time. I dismissed it because it seems like all they're really saying is they had the same reserves as last month. So they went 1 month without buying any more. That doesn't seem like big news to me. What am I missing?
It's big news when you consider how big of a shift in pricing this is for gold, because everybody's scratching their head in 2024. You had real rates go up. You had the dollar strengthening. These are two factors that would typically make the price of gold go down, yet gold continues to go up. So the central bank demand from the emerging markets is fighting the traditional fundamental drivers of gold. And that's why it's so important. But it's also useful to take a step back. Why are these emerging market central banks buying so much gold? I like to put it in the context of why have we not seen dollar recycling? And by dollar recycling, I mean, let's say you're China, let's say you're Saudi Arabia. You sell your commodities and your goods, you raise a lot of US dollars. Historically, you would take those US dollars and you would buy US treasuries. This would lead to lower yields in the US, which would then weaken the US dollar. And that weaker US dollar would reinforce reflationary pressures when then they would earn more. And it was a virtuous cycle that would create reflationary pressures and lower yields in the US and a weaker US dollar. And that manifests itself in a negative correlation between the dollar and the oil price. And if you look at dollar and oil, they too have disconnected, where you have stronger oil prices connected to stronger dollar. It's the opposite of what we had seen. And this all started when we went off the gold standard in the early 1970s. The 1970s were characterized by dollar recycling. The 2000s were characterized by dollar recycling. So this is representing a significant divergence from the past. Now, the question you have to ask yourself now is, why aren't they recycling the dollars into U.S. treasuries? One answer I get is fear around purchasing dollar-based assets, given what they saw with Russia following the Ukraine invasion, meaning, asset freezes or something of that nature. My own conversation with, many of these emerging markets that are not recycling dollars, they tell me it has to do with the yields at 4.5% on the 10-year are simply not high enough relative to their inflation expectations. I don't want to get into reasons why they're not recycling the dollars. Let's just go with the observation they're not recycling the dollars. So what are they buying? They're purchasing physical goods. Like Saudi Arabia has had deals with the Chinese where they barter oil for machinery type goods. We see trade in local currencies. They're finding many ways to get around this. But ultimately, in the end, the settlement is been in gold. And that's creating that excess demand. When we look at the the increase in demand and the central banks of Russia and China, the two big holders, it's increased by 60% in this post-COVID era. That's a lot of gold buying. And that's ultimately what's generating these different correlations that we're not only seeing in gold, but we're seeing it in oil and the rest of the commodity complex. And it's a big fly in the ointment because we see commodity prices trying to go higher, yet they run into the headwind of the strong dollar because you're not getting that virtuous cycle. So the way I like to label what we have seen is gold recycling replacing dollar recycling.
Jeff, let's go a little deeper on the gold trade to start with. Is the bullish thesis still sound? Is there still more upside in this gold bull market? And if so, how should we react tactically to what just happened? Because Friday's close was the first close in months below the 50-day moving average. That, in the eyes of some technicians, would be a sell signal. Time to pare your gold position back, expecting further weakness. Buy it back in at a lower point. Other people would say, hey, you just had a $100 down day in a bull market. Buy the heck out of this right here. Don't miss it. Which way should we look at it, and where is this market headed from here?
Yeah, I like to say again, 1 month's data does not establish a trend. And these fundamental drivers that we're talking about, in the sense that the emerging market central banks are not recycling dollars at the same rate they were before, but instead buying physical assets, bartering with other commodities. It shows that this is a new paradigm. As someone jokingly said to me the other day, it's like the emerging markets are trying to force us back onto the gold standard. These forces, they're not going to change. They're not going away. They're probably going to get more embedded as we go forward. Because if you really want to put it at its heart, it's part of this whole deglobalization process, where you want to call it China block, U.S. block. I don't want to get into the terminology we use for this. Is those types of forces, they're with us. They're likely to grow stronger. And gold's going to be a central part of this. And we're likely to continue to see more central bank demand, because if you even take like China, that demand that we've seen for going forward, all that's done is kept their reserve ratios between gold and other assets constant. And it does not include other central banks joining the same type of dynamic here. So, I'm still very much bullish on gold. A price range of 2,700 to 3,000 in the next year seems like a very reasonable bet if you see these fundamentals continue.
Let's move on to another metal, copper, which also took a nosedive on Friday. Was copper's nosedive on Friday related to gold's nosedive? I know you've been very bullish about copper in the past. Is this correction still young, or is it already played out? Is it time to buy the bottom? How do we look at the copper market?
I would argue it's part of a bigger correction that's been going on for about a week and a half or so. Obviously, it was accelerated by the labor report that came out on Friday. But I think there's a bigger issue connecting it with the discussion earlier about the end of dollar recycling. We don't have in this commodity bull market that virtuous cycle of a weak dollar reinforcing reflation, creating more dollars in places like Saudi Arabia and China, and for reinvesting it back into U.S. Treasuries. It was that virtuous cycle of dollar recycling that really allowed commodities to rally at a pace that would increase over time. The one thing about copper is its length and interest from investors is very high right now, but that price struggles to get over $11,000 a ton. It's like it peaked its head above there, took a quick look, and then boom, it got crushed back down into the lower 10,000s, and then got hurt further at the end of last week. I think that is, it's symptomatic, is that particularly in the metal markets, they're struggling against that headwind of a strong dollar. So let's take that out of the picture. And I think, when we look at what happened last week, is you not only had the labor report take away some of the probabilities of, rate cuts, but you also had the ECB cut rates, which then further strengthened the dollar. So there's a big headwind that, markets like copper are fighting. But bottom line, The reason why investors like copper is that the story has an anchor. It has something that's very easy to understand out in the future, meaning that copper is a superconductor. It can conduct electricity better than any of the other metals. For those who don't know what superconductors are, if you look at the periodic table, there's 3 elements that sit in the same column: gold, silver, and copper. And those are your superconductors. Now, gold and silver are too expensive to go out and wire the world with, so we choose copper to be the superconductor of choice. If you believe we're going to decarbonize the world, you believe we're going to need a lot of copper to electrify it. And that's what creates that longer term demand that has investors comfortable in seeing through any type of near term noise to own copper long term. And when we look at the fundamental picture for copper today, part of the reason why it's sold off, it is. We'll talk about oil further down. You can't give oil away to an investor, but the fundamentals of oil are better near term than what they are for copper today. Now, that's been proved. I think you and I were talking, Eric, copper has moved back into backwardation. But I think the key point here, in the term when I was at Goldman, we called copper the new oil. Because it's going to be the strategically most important commodity. I think that still holds true. And I would view the sell-off as being a buying opportunity for thinking about copper longer term.
Let's talk about that backwardation specifically. You know the commodities industry far better than I do. It seems to me that there's a very strong long-term structural argument, which is that if copper has historically usually been in a contango market, meaning you have to pay a roll premium every month in order to hold a long position, and it transitions into a longer-term structural backwardation, which seems to be happening right now, that would mean that copper would have the same characteristics that oil has, which is you're actually better to hold the commodity than to hold producers of the commodity because you're getting paid a roll premium every month as you roll that position forward. Is that the right way to think about it? And could that be the reason for copper becoming a super popular trade in coming years?
I absolutely think that the carry is going to be critical. By the way, copper used to be backwardated all the time like oil pre-08, 09. It was after 08, 09 that it started having, in fact, copper, we'd argue, traded like an emerging market equity because it was a proxy for what was going on in China. And from that point forward, it was always being driven like a proxy for the MSCI. And by the way, go back and look at the correlation between copper and long-dated copper and the MSCI for emerging markets. It's mind-blowing how correlated it was, which tells you that copper was a unique commodity in the sense that it traded more like an equity and on those future expectations of fundamentals in the EM. And what's been different about 2024? And why is copper finally working? Because, by the way, I think the last time you had me on this, Eric, I was pounding the table buying copper. And the time before that, pounding the table on buying copper. I sound like a broken record. Why is it finally working? The reason why is that disconnect between the emerging market story and the decarbonization story. People could not buy copper a year and a half ago or 2 years ago when they knew the Chinese property market was sinking. They needed to see evidence that the green capex story could dominate the property market story in China. And we have seen that over the last year, and particularly in the first half of this year. So people have decoupled that emerging market story from copper and now have connected it to being a commodity type story, which is why we're seeing the backwardation return, because it's now behaving like a commodity and less like emerging market equity. So I would argue, your case in point here is that roll yield is going to be an important source of returns going forward, which is unique to the commodity markets.
Let's move on to energy, particularly the crude oil market. We just saw a brief trip down to the low 70s. That was on the back of some OPEC Plus news that they were not going to indefinitely extend their production cuts. We're starting to bounce back off of that, right around 80 on Brent. Where are we headed from here? What's the big picture? Where is this market headed?
I'm bullish on oil rate. I'm even maybe getting above 100 is a stretch, but from here into above 90, I think is a very realistic outcome, particularly given where we are in the business cycle. It is late cycle at this point. If you think about 22 and 23 as being the mid-cycle pause of this current cycle, meaning that period where the central bank raises rates, the system pauses, it accommodates and acclimates to the higher rates, higher energy prices, rebalance itself, and then takes off in the second half of the business cycle, and that's the late business cycle. That is when oil and commodities perform best. I haven't checked it in the last couple of weeks, but when you put it all together, commodities were the best performing asset class. I know that was true 2 weeks ago. I don't know if it's true today. So I just want to caveat that. But I think the key point here is commodities and physical assets always perform better in this environment. And we don't think that this cycle is any different. Now, I want to talk about the business cycle and then talk about the structural story further. But I think when we look at the fundamentals of oil today, they're not that bad. But by the way, the spec position in oil is the lowest it's been in well over a decade, lower than what it was when we went to negative oil prices, at least in Brent. And you put it all together, the market is acting like we're in the middle of a recession or some other crisis from an investor perspective. Yet the fundamentals, we just came through the shoulder months. OPEC, gave a plan to increase production conditioned on if the demand is there. So they didn't really provide that much new information to it. Most people had that oil coming back in their balance tables in June anyway, and they just got pushed out. So to me, that seems kind of bullish. The jet travel season, the gasoline driving season, all off to a big start so far. That weakness in demand that people focus on was during the winter when you had the warm weather derail the demand for oil. And even then, you take that bad start to the year, we're tracking around 1.3 million barrels per day of oil demand growth. That's above trend. I want to repeat that. That's above trend. And this is supposed to be a bad year for oil. What has oil done in that post-2019 period outside of COVID? It's done nothing but surprise to the upside. Yet everybody is concerned about oil demand. And when we think about copper, I said before, investors will buy copper because they see an anchor to it. They're comfortable in that long-term demand story. They don't want to touch oil because they do not believe in the long-term demand story. However, what is a commodity super cycle? A commodity super cycle is a CapEx cycle. And I don't think anybody listening to this is going to disagree. We aren't beginning a big CapEx boom driven by green energy, defense spending, and you're seeing it across the commodity complex. So we have that makings of a commodity super cycle through a CapEx cycle that is stimulative not only for metals demand, but also for energy. And I'm just going to go back to the bottom line observation is oil demand is trending this year in a weakened environment above trend demand growth, and it has done nothing but surprise to the upside. So that's my foundation of being bullish. But I want to add it even on the supply side, that all that spare capacity is isolated in a few. Spare capacity of oil production is isolated in a few countries, Saudi Arabia and the UAE being the largest there. We look at the surprises in U.S. production that occurred last year. They're not repeating again this year. And when we look at the non-OPEC production increases that people focus on, whether if it is places like Guyana and Brazil, which are disappointing now, that's from CapEx spend that goes back nearly a decade ago. So we look at the pipeline of new investment, it's not there either. So let's look out past 2025, 2026. I would argue oil starts to become much tighter, but people are unwilling to buy that longer term story, which is why positioning is so weak in the current environment. But, the one kind of markets I like to own are the markets that are really short. And this is one that's really short. The fundamentals don't match. It's positioned for, I think, a pretty big, significant rebound in prices, particularly as fundamentals improve as we get into the summer driving season. So I'm much more positive on energy near term. I love copper story because I got that anchor and feel comfortable in it longer term. And I think that people should feel more comfortable about oil because we're not going to get to that death scenario on oil demand that people fear for at least another decade or more.
We've had a few different MacroVoices guests share and express the opinion that U.S. natural gas prices are headed much, much higher in coming years. The reason is they expect essentially that an arbitrage becomes efficient, where the export of natural gas from the United States basically allows U.S. and European natural gas prices to balance each other out. That seems to be perfect logic to me, but I've been hearing that story for years and it hasn't happened yet. Is there something inherently wrong with that it's not going to happen, or is it just slower to happen than people thought, or what's going on there?
It happened in 2021 and 2022. Everything disconnected in 23 and the early part of 24. And one of the reasons for that is, let's not forget, China, India, and Indonesia took coal production up the level of Saudi Arabia, the equivalent of over 7 million barrels per day. That's a lot of energy that hit the global market. And what does that back out? It backs out LNG. Now, that's part of the reason why gas prices went negative in 2023 in Europe. And we saw gas prices in the U.S. sink to, all-time lows on the NYMEX at the first part of this year. So, there's a lot of one-offs. And the one thing that I'm comfortable saying, the conclusion of energy transition is that, particularly given renewables, that reduces our ability to create a cushion and store and increases intermittency problems, means gas and power prices are going to be a lot more volatile. You're going to see these disconnects in the fungibility like you're referring to, where it disconnects, drops down, but your ability to explode back to the upside once everything gets tight again is substantial. And I don't think we've seen the end of this commodity or energy crisis on a global basis, because again, the investment is not there. Demand is at the low point. It's likely to rebound, and that's going to put pressure back on the system. But I agree with those that have come on the show and talked about the fungibility of commodities, because in my 30-year experience of doing commodities, the one thing I've never will underestimate after watching it over and over, you may not see the pathway for two commodities to connect through energy content or some other source where they substitute, but somehow, some way they will. Whether if it's exporting coal around the world to connect them or exporting chemical goods, where there's a will, there's always a way. And the one thing that I have learned to never underestimate is the fungibility of commodities and their ability to connect to one another. So I agree with those who've come on the show and made the point that, ultimately they're going to connect. But what will that do? It will create much higher prices. The system will adjust, and it'll probably let go again, and you'll come crashing back. I like to point out, at the core of a commodity super cycle, it's not this idea of steadily rising prices over time. There are a sequence of spikes. And that's what, if you look back at what happened in the 2000s, it was spike after spike. What happened in the 1970s, it was spike after spike. And those spikes occur when you actually see that fungibility and that connection that you're referring to take place. So I'm very much in agreement with that. But I think the place where I will probably disagree, it won't be lasting. It'll just tee you up for the next price spike.
Jeff, while we're on energy, let's move on to uranium, something that's really interested me. I've seen some incredibly strong bullish arguments for the uranium market right now based on Justin Hune's analysis of the physicals and so forth. The thing is, the buyers are just not moved by it. Justin just went to the conference. He tells me that when he went to the conference, the buyers have no sense of urgency. Everybody's complacent. They're not worried about uranium demand on the buying side. What's going on here, and is this a market? It seems to me like it's set for a rude awakening where the buyers realize, holy shit, this is not just another 2007 spike. We have a structural problem here. Would you agree with that analysis, and where do you think that the uranium market is headed?
Yeah, I'd agree with that analysis. And one of the pushbacks I get from people, they go, yeah, I hear you. It's all great about nuclear power and uranium, but when you look at the cost basis, they don't hold a candle to renewables. That's the pushback I get. And my answer is twofold. One, you're not factoring in the intermittency costs of the renewables. That substantially escalates the overall cost structure. I've seen estimates as high as 14 times. Because remember, you got to replace that intermittency of that solar or wind, something that's close to being free, with something very expensive in places like Europe in 2022 and 2023. It was really expensive. So that's one reason. The second reason I think that they underestimate is that a lot of the costs on the nuclear side that makes it more expensive comes from the bureaucratic red tape, which I know you're an expert in, and Eric. But I think those are many of the factors that create why people are not that optimistic. I'm in the camp. Yeah, I think the upside here is substantial. If we are going to decarbonize at the rate the world would like to, nuclear has to be central to that thesis, which means you're going to need a lot more demand for uranium to be able to fuel a carbon-free energy source. So I'm very positive on it, but I agree with you, the investor pushback. And I think that pushback is underestimating the real true cost of many of these alternative sources with renewables front and center.
Let's move on to a couple of commodities that have seen some really big price action lately. That's coffee and cocoa. What the heck is going on there?
Climate change. When you look at coffee and cocoa, they're tree commodities. They primarily come from the equator, the belt around the earth. And that's the area that's being substantially impacted by climate change, whether if it's in, Central America and Honduras and places like that where coffee production has collapsed. And I think the one thing that cocoa is separate and distinct from coffee in is that the demand for chocolate was hit particularly hard during COVID, because where do you sell a lot of the chocolate? It's in airports, and airports shut down for 18 months, 2 years during that time period. And so the demand was hit pretty hard. That collapse made the collapse in prices that much bigger. You didn't have the supply that has now been hit by climate change. Why do I comment that these are tree commodities? It's going to take a long time it's not like corn where, the stock comes down and then you replant it and it grows again the next year. Trees take a long time. Coffees are more bushes than trees. But, the key point here is that, you're talking years to rebuild the supply base of these different tree-based commodities. So, where are we in this process? Again, what is the definition of super cycle? Sequence of spikes. We just saw, a price spike above 11,000 on cocoa, and then it, crashed back down to 7. We're up 8 or 9 again. It's that type of volatility that's going to be apparent here. The one way you can think about it, you run out of supply, you run out of your inventory buffer, you go into those knife edge equilibrium, which means prices can spike really high to the upside and they can get crushed down to the upside. By the way, we're getting close to that on copper, and it will be there in the next 12 months, similar to what we saw in cocoa. But if you're thinking about the softs, coffee and cocoa in particular, this process is going to be a very long journey, given the fact that they're tree commodities and reproducing supply is going to be very difficult.
Jeff, you've mentioned the commodity super cycle a few times. That's been a contentious phrase. Some people think there is a super cycle. Some people think there's not. Why is it contentious? Why do you argue that there very much is a super cycle? And why is it a capex cycle as opposed to just a supply and demand cycle? How does this work? What do investors need to understand in order to anticipate how that capex cycle is going to affect commodity prices?
Well, when we look at the history of capex cycles, I have a great chart that takes capex back to the 60s and puts real metals prices on top of the capex cycle. They're perfectly correlated. You see a big capex cycle in the 70s that peaks right when Volcker goes in and really raises rates. And then you see another one in the 2000s. the data shows you're already back up into another CapEx cycle. Think about all the IRA money in the U.S., the AI investment around, the AI technology in the data centers. All that's creating a huge CapEx cycle. By the way, the three big drivers of this CapEx cycle are going to be AI data centers, decarbonization, and then you have deglobalization. The three Ds here: data center, decarbonization, and deglobalization. And you can think about the deglobalization as being defense spend. And when we think about the 70s, the CapEx cycle was similar in nature. You had huge defense. Remember, that was guns and butter. And then you had desulfurization as opposed to decarbonization. And then you had the war on poverty. That was the Great Society. So the amount of CapEx there was unprecedented, the biggest one we've ever seen globally. And it helped fuel a commodity supercycle. The one in the 70s wasn't as inflationary because it was driven by China, which then created some deflationary pressure in the West. But the concept was exactly the same. And we're seeing that same type of CapEx boom. Why does that create strong demand for commodities across the space? It's stimulus. Also, who's going to get those jobs? It's going to be low-income, blue-collar workers who spend more on commodities. So the setup is very similar. In fact, early estimates suggest, particularly given the magnitude of decarbonization, that the investment this decade is going to be equal to one China in the 2000s. In next decade, it's two Chinas. So, this is going to be 2x China, given the magnitude of the investment, which is why the upside on copper here is substantial. And I think the other pushback, people are going to say, well, there's more than enough oil supply. We got a lot of oil supply because we saw governments around the world turn a blind eye on some of the key initiatives that they thought were important going back to 2020, whether if it was sanctions on Venezuela, sanctions on Iran. Both are producing substantially more oil today than what they did in the past. Sanctions on Russia. Russia's producing near max capacity. And then what about environmental? More coal is at a record production right now. Chinese coal is, near a peak. And same thing with Indonesia and India. By the way, on Chinese coal, let me point something out here. And I've watched this now since 2015. Since 2015, no commodity bull market can occur without Chinese coal rolling over. And there's a lot of evidence pointing that it's beginning to roll over right now. Why is that the case? Because they power the steel mills, the aluminum smelters, the copper refineries, all being powered by coal-fired generation capacity. And then if you take the coal out, you not only lose all that metals production, but you got to replace it with LNG, which then tightens the global LNG market and then tightens the rest of the global market. So that coal is really critical there. But I think the key message here is that coal production, that increase, I was talking about that 7 million barrels per day, that created a lot of supply of energy around the world. That looks to be abating. But I think those are the two reasons why people really push back on the super cycle thesis, is that they see that supply creating a pause in those energy bull markets. And the fact that copper has just struggled to get above 11,000. I think the other thing that needs to change here is the strength of the dollar needs to abate. That's a whole different MacroVoices discussion. I'm sure Eric, you've done that many times on the outlook of the dollar, given the deficit spending in the U.S. Although there's another one, but it's pretty hard to argue the dollar could get much stronger than here. So I'd view that as being a tailwind too, as we look further out.
Well, speaking of broader MacroVoices topics, I want to move on now from the commodities supercycle to the Jeff Currie supercycle, because, Jeff, you had what a lot of people think is probably the top job in the entire industry in commodities. You were the head of global commodity strategy for Goldman Sachs, probably the most prominent and highly respected investment bank in the business. You left to go to Carlyle, a big firm, but still a smaller firm. Most people wouldn't have done that. So what's going on? Why would you leave what a lot of people thought was the top job in the industry? There must be a backstory to what you wanted to do or why you wanted to do something that was different. And what is the new position at Carlyle?
I love the opportunity to talk about this. It was more, an opportunity. I don't want to be cheerleading on this story of this super cycle this time around. I want to be participating in it. And, Carlisle is one of the best places to be able to establish that ability to participate. It's a, iconic franchise, pioneers in the private equity space. But here's a really important reason why Carlisle is don't underestimate their DC roots and their connection to policy. Because let's not forget that the green transition, we would have done this decades ago if the economics proved that they could be superior to carbon-based fuels. They aren't, which tells you policy has to come in and drive this. Where did Carlisle get its roots? It was doing defense. Again, policy-driven spending. And what are we going to see in this commodity super cycle? Massive amount of policy investment to push the green agenda and reduce carbon, because it's not going to happen by the economics on their own. We have defense spending like we've seen before, but this is going to be higher. So you have those same forces at play, particularly from the policy side, for which I would argue Carlisle's in a good position. And the third reason is it's a world-class energy franchise. They've survived the last decade and a half, and very, very few have remained committed to the overall energy sector. And there's one last thing. We use the term energy pathways. What do we mean by energy pathways? So far, when we think about this, the energy transition, the focal point has primarily been on the green and only the green. This has created a disorganized, chaotic transition. And by pathways, we suggest you got to be focused on the brown and the green and the pathways connecting the two. Do we know what that pathway looks like? I could argue absolutely not. I like to point out when we desulfurized in the 70s, did anybody actually know at the time that if you put platinum and palladium into the muffler of your car, you would get rid of all of those aerosols that were creating the smog and the problem at the time? The answer is no. It was a pathway that required trial and error and investment. And that's ultimately what we need to see happen in this environment. And so that's why we like to, let's focus on the pathways between the brown and the green. And there's another important point here is there's been a disowning of emissions in brown assets. That doesn't solve anything. In fact, anything, it shirks the responsibility of decarbonization. If you're going to decarbonize, the only way you control those emissions is if you own the emissions and then you turn them down. By just pushing them out of the portfolio, they just go somewhere in the world like India, Indonesia, China, and the production goes there and they never go down. And so the problem with net zero, by just taking everything out of your portfolio and going, we're there, is they're not actively engaging the decarbonization process. And so what we argue, you have to own the emissions to control the emissions. And I think the key point here, I'm not trying to dismiss net zero, but I think the key point here is that the decarbonization here needs to also focus on the change in emissions, bringing the emissions down as opposed to some concept of net zero. So let's get them down this year. What about next year? And I like to point out what Carlisle, through investments in like subs and so forth, they have got emissions down in some of these brown assets. And I think that's an important accomplishment, particularly in the environment where we see emissions going up. And so, I'm excited about being a part of this. And I think they're incredibly well positioned, to help facilitate the energy transition, particularly given, its roots connected in policy, because let's not forget, this is going to be a policy-driven event.
And what is it exactly that you're doing? You're managing a fund or you're doing something else? What's the something else?
Oh, I'm part of management of a fund. I'm the chief strategy officers of the entire group that's going to focus on these pathways. And my role is a little bit like it was at Goldman, educating our clients on the different aspects of energy transition, and then being a part of both raising funds as well as being a part of the deployment process, which the deployment process I think is going to be very exciting because there's a lot of different new technologies that are coming our way and interesting to look at.
Well, Jeff, I can't thank you enough for a terrific interview, but before I let you go, please let our listeners know how they can follow your work, how they can contact you for our institutional listeners who may be interested in your fund offering, and generally how to follow the new Jeff, the post-Goldman Sachs Jeff.
So great. Well, by the way, we don't have a fund offering yet, but we would love to hear from you. My email now is just like it was at Goldman, Jeffrey.Currie. Now it says at carlisle.com. So I'm fairly easy to reach. It's still early days. We've not started to publish and put things out yet, but we would love to hear from you. And please reach out to my email. And thank you, Eric. This was a very enjoyable conversation.
It's always great to have you on, Jeff, and we'll look forward to getting you back for an update in a few months. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jeff Currie back on the show. Now, joining us again in the postgame segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying, looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory.
EIA posted builds across the board, with crude oil building 3.7 million barrels. Cushing, Oklahoma drew down 1.6 million barrels. Gasoline building 2.6 million barrels. Distillates building 881,000 barrels for a net petroleum build of 7.2 million barrels, with U.S. production ticking back up 100,000 barrels to 13.2 million barrels. The market seems to have found its bottom and is trying to recover, but I'm still not holding my breath for $100 oil prices. We've got so much spare capacity in the system, and so far we're just not demanding enough. Now, I think in the next couple of years that's going to change. We're going to get into a real global energy crunch, but it's not time quite yet.
Well, Eric, I just wanted to highlight a quick thing on the oil chart. Now, we had a very nasty drop in oil markets the other week. And when you have a mean reverting rally of the magnitude we saw this week, where we almost reversed the entire sell cycle of the late May sell-off, it to me is at least showing that the fair value of oil is much closer to 80 than it is down to the low 70s. What I'll be looking for in the next couple of weeks going into early July is whether or not the price action stabilizes up in these levels, indicating that there isn't another leg down in the crude oil sell cycle. The more we see price action stabilization, the more we can speculate that the short-term lows in oil are in, and that could lead to buying opportunities in July and August. Now, let's get Nick involved in this conversation. Now, Nick, on pages 3 and 4, we have the S&P 500 and the QQQ levels. What are the levels you're watching, and what are you thinking of the markets here?
Yeah, Patrick. So right now on SPX, we have a spot price of approximately 54.20 and an implied move for next Friday, June 21st, OPEX of plus minus 60 points. Therefore, the upper implied move is 54.80. And the lower implied move is 53.60. Right now, we have no key resistance as we're at all-time highs, and we have key support at 53.50. On Qs, we have a spot price of 477 and an implied move of plus to minus 7 points for next Friday's monthly OPEX. Therefore, we have an upper implied move of 484 and a lower implied move of 470. Right now, I think we see that blow off top toward that 5,500 mark. I don't really see us pushing much further than that level, though, in the short term. Possible test at 55.50 or so, but I do see us having a small pullback thereafter, somewhere around that 5,300 mark overall. I'm looking at names like NVIDIA right now after the split. It should still run to the upside. Apple has had a monster run the last couple of days as well, gaining about 12%. One interesting thing to note is that over the past year or so, the top 10 companies in the S&P 500 have accounted for about 2,000 points in the S&P. So if you were to measure those companies on their own, separate from the remaining 490 names, they would be at around a level of 8,000 on SPX, whereas the remaining names would be at around 4,000 and change. So interesting to note that because we're seeing a very top-heavy market. I want to look for more broad-based buying in the small caps if we're to see a further leg higher.
Well, needless to say, the melt-up in equities is continuing this week. But Patrick, you're the options hedging guy. I know you did a special webinar for our MacroVoices listeners back at the start of the year discussing that it's never been cheaper to hedge your portfolio. It seems to me like now is a relevant time for fully invested investors to consider doing exactly that, managing downside risk without having to sell their holdings. Because quite frankly, I don't think these absolutely guaranteed certain to happen no matter what. Rate cuts from the Fed are really all that certain to happen no matter what. And if they don't, I think we could see some volatility in this market. So is the opportunity to hedge still as cheap as it was at the start of the year? And what's the update generally on that strategy?
Yeah, Eric, it's still an incredibly cheap period to hedge downside risk with a number of interesting strategies. Before I get into the details, I wanted to discuss for a moment the principle of the pain trade that only the seasoned MacroVoice investors understand through experience. The pain trade in investing refers to a market scenario where the majority of investors are positioned in a particular way, but the market moves in the opposite direction, causing widespread financial losses. The term captures the idea that the market often takes the path that causes the most discomfort and financial pain to the largest number of investors. Back in 2023, there was no shortage of bears anchored off the regional bank failures and the yield curve steepening. But I was skeptical almost solely on the simple principle that markets rarely have big downside moves when a large number of the investors are expecting or planning for it. The greatest downside risks are almost always associated around periods where investors are all crowded in on the wrong side of the trade, and liquidity events are almost always associated with that crowd all being forced to sell at the same time. Now, historically, nearly every interest rate cutting cycle has coincided with a recession either just before or shortly after the rate cuts begin. This pattern can be observed in the years 1974, 1989, 2000, 2007, and 2019. Recessions typically follow a period of tighter financial conditions due to rate hikes, with the subsequent rate cuts eventually loosening financial conditions and aiding the economic recovery. Despite this historical trend, the Federal Reserve Chair Jerome Powell and many mainstream analysts are optimistic that the current cycle may break from this pattern and a soft landing or no landing scenario. Should you trust this optimism? Is it really different this time? Is it now time to sell assets and raise cash? It has never been more affordable and strategic to insure your portfolio. Many investors face challenges in selling core securities, whether it's due to tax implications, trading restrictions, or the complexity of such decisions. This is why portfolio insurance through hedging is an effective strategy for managing your portfolio risks. There are two key drivers behind the cheap portfolio insurance: low implied volatilities and high interest rates. Most people track the VIX, the 30-day volatility, but on page 5, I have the chart on the 1-year VIX, looking back close to half a decade. We are at the lowest levels of implied volatility in the post-COVID timeframe. Investors can execute a simple trade like just buying the downside gamma. But what other strategies can you consider for mitigating the costs? What time frame should you hedge? What strikes should you consider? There are many important questions that deserve a much deeper conversation than a quick mention here in the post-game conversation.
Now, you're hosting a special webinar to go deeper into the current market conditions. When is that, and where can people register?
On Tuesday, June 18th at 11 a.m. Eastern Standard Time. The link is in the Research Roundup email, but you can also register by just simply going to the website, bigpicturetrading.com.
And for any listeners who are unable to attend live, will there be a recording available?
Yes, anyone that registers for the event online will be able to access the recordings for the live session if they're unable to attend.
Looking forward to that webinar, Patrick. let's get through the rest of the chart deck, starting with the US dollar.
Yeah, Nick, it's been absolute confusion on the dollar over the last week. We had the ECB, we had the European elections, and then subsequently the CPI numbers and the Fed, which basically have seen huge whipsaw in both the euro, the US dollar, and many other cross currencies. At this juncture, I wouldn't classify any of this as a breakout. So while it's been stuck in this range, we still are going to be watching for when the dollar makes a commitment to a trend breakout, which simply hasn't emerged yet.
And moving on to page 7, we have that gold futures chart. Eric, what are your thoughts here?
Wow, what a difference a day can make. As of Thursday, the gold chart was looking terrific, just powering ahead. I thought we were headed toward new all-time highs again. But as Jeff mentioned in the feature interview, what everyone's attributing this big $100 shock move down last Friday to is China's announcement implying that they may have paused buying more central bank gold reserves. Frankly, I don't think that explains the move. Maybe that was the catalyst to get it started. I think probably this mostly has to do with the market finally pricing out any hopes of rate cut expectations. The China announcement, as far as I can tell, was just the catalyst that got the ball rolling. The next obvious support comes in at 22.85, but frankly, everybody's talking about that. There's a support level at 22.85. Well, hang on a second. The 22.85 support level really only shows up on the continuation chart. My general rule when the continuation and contract charts don't really jibe is the contract chart for the front month futures contract is the one that wins. And when you look at the front month futures contract in gold, we've already retested that low from April. It's not 22.85 on that chart. It's only 22.85 on the continuation chart. On the contract chart, we're already there, and there is no further support all the way down to 22.56. So is there really a support level below the market at 22.85, or is the first significant support not coming until 22.56? I guess that depends on which technician you're talking to, but I see it as really no substantial support until 22.56. So let's see what happens. It might be that it's already over. Frankly, I didn't expect the big $100 correction to happen when it did. Maybe it was just a panic that's going to come back out of the market after we got a little bit of a dovish surprise from the FOMC this week. We'll see what happens.
Well, Eric, in my mind, we are in the midst of a correction, but I don't want to try to over-explain it. Markets always work in these cycles. There's the expansion cycle where assets rise and then they mean revert and correct. Gold had an extraordinary run at the start of the year, and we're going through some sort of a consolidation period where the price of gold is going to stabilize after such a strong push. I think in the bigger picture, it remains incredibly bullish, but to the levels that you're talking about, we could easily still see 22.85 or 22.50 during pullbacks. But in my mind, those are all bigger picture buying opportunities.
And moving on to page 8, we have that uranium chart. Eric, what are your thoughts here?
Well, my view on uranium has changed a little bit, so I'm going to go into more detail than usual this week. In the long term, I remain unconditionally convinced that uranium prices are headed higher and much higher. The supply and demand imbalances in this market are immutable, they're staggering, and they're only going to get worse. But my views were greatly influenced by a video report from our friend Justin Hune over at UraniumInsider.com. Now, it was a subscribers-only video, so out of respect for other paying subscribers, I can't tell you too much about what it says. The gist of it, though, is Justin tells us the mood at last week's nuclear fuel buyers conference was very much one of complacency. The buyers are not of the opinion. They haven't been listening to MacroVoices. They don't understand the supply and demand imbalances that are building in this market and only set to get worse. They think this is just a temporary price deviation. It's all going to mean revert back down to the low side. They're not in a hurry to rush out and buy any uranium. They're happy to just wait for the price to go back down below $50. Now, that's not going to happen. I don't think they're going to get any $50 uranium. But the point is, this market is driven by a utility industry which very much can afford to take its time. If they decide tried to organize some kind of buyer's strike, that will eventually fail because the market fundamentals are just overwhelmingly bullish and overwhelmingly strong. But they could easily consume 6 months having it fail before they figure this out. And it sounds like from Justin's report, they really don't have it figured out yet. What Justin said was the buyers are just not concerned. The consultants and analysts are in the room saying, hey, guys, seriously, it's not this 2007 spike. It's different fundamentals. It's a different story now. You should be concerned about this. Well, they haven't gotten concerned about it yet. And until those physical market buyers do get concerned about it, we're not going to see a big move in spot uranium prices. So I think what's going on here is everybody, myself included, who was anticipating this move, got a little bit ahead of ourselves, a little too far out over our skis. We bought up the best uranium mining shares, and now they're pulling back kind of substantially as some people are getting tired of waiting for this trade to happen. The least patient money is already out of the trade, and I think more impatience is growing on the part of these uranium longs. Ultimately, there's no doubt in my mind that this resolves in the final outcome to the upside on price, and that there's a really big upside move in these uranium mining shares. But until we get that underlying move in the spot price of uranium, there's no reason to expect uranium prices to move higher. And I'm getting concerned that if the buyers are organizing some kind of strike, look, in the long run, they're only sabotaging themselves, and rather badly, because they're injuring the source of capital that's needed to build the mines that are going to sell them the less expensive uranium 5 to 10 years into the future. So they're only shooting themselves in the foot, but that's not going to stop them from doing so. It never does. They're not going to see it that way. So I think this market is definitely headed to the moon when everybody, including the buyers, understands what MacroVoices listeners already know. But if the buyers don't get it, they can delay that next big move. The nuclear plants are not running out of fuel tomorrow. They only have to be refueled once every several years. And the buying necessary to support that doesn't have to happen tomorrow morning. So if they want to take their time and wait for prices to come back down, they can drag this market out, and I think that's what's happening. So the question is going to be, how long can they drag this out before the other speculators in the uranium shares start bailing and saying, we don't have time for this? I think that's what's starting to happen, and I think that could take the uranium mining shares quite a bit lower if the market takes a while before the spot price of uranium starts to move. When the spot price of uranium starts to move, which it has to sooner or later, then I think you're going to see an explosion of these uranium mining shares. But I wouldn't be at all surprised now that we've taken out the 200-day moving averages to the downside on some of, frankly, the best names, the companies like Denison and Next Gen Energy and Encore, which are all excellent companies in excellent jurisdictions with no jurisdictional risk. Those stocks have gotten nailed in the last week. And the reason, I think, is just because a lot of us got ahead of ourselves and thought the spot price of uranium was going to start moving sooner than it did. Other companies like Global Atomic and ISO, symbols GLO and ISO, got completely nailed this week when other issues like Global Atomic do have jurisdictional risk associated with them. But I think the reason the stocks are getting nailed is just because of everyone getting impatient. We all thought the spot price of uranium was going to move sooner than it has. And it sounds like the physical market buyers are just not persuaded yet that they ought to be concerned about whether they're going to be able to buy uranium at any price, which I think is a very real risk. They're not concerned about yet. When they get concerned, that's when this market's going to explode. And I think there could be a deeper pullback before that starts to happen.
Well, just make the observation that the Sprott Uranium Physical Trust has had that much more selling than the main spot price of uranium. Very aggressive selling that has made it quite oversold in the short term. I still believe in the bigger picture that the uranium story is a great one. And therefore, these types of sell-offs, especially when something like the closed-end trusts like Sprott are selling at such a deep discount, is always an opportunity to fade that selling.
Again, folks, if you're interested in Patrick's special webinar, you'll find the link to register in the Research Roundup email, or you can register at bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview and the chart book we just discussed here in the postgame, including a link to the special webinar we're going to be hosting on June 18th. You're going to find that link and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @Eric S. Townsend. That is Eric spelled with a K. And follow Patrick @Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.